two brilliant bankers. As of now, we are going through the subject bank financial management, and we have already completed the chapter. We are on the verge of completing the chapter facilities for exporters and importers. Till now, we have gone through the particulars of facilities for the exporters, and we have completed the previous session with factoring and forfeiting. Today, we will be starting with the guidelines for importers. So, what are the guidelines for importers who want to import anything? This is as per the exchange and trade control guidelines for importers. So, keeping in view the need to conserve the precious foreign exchange and to guard the country against the scrupulous imports and bogus outward remittances, various export and import regulations and exchange controls have been prescribed from time to time, which was also mentioned in the details when guidelines for exporters were being updated. So, coming on to this point, so what are the things that are mentioned by DGFT, the Director General of Foreign Trade? The regulations relating to payments of such imports are governed by the Foreign Exchange Control Regulations, which is under the Foreign Exchange Management Act of 1999. The first thing is first, the importer, any importer or exporter should have an IEC number, that is an importer exporter number, without which he can't perform any transaction of importing or exporting. And this IEC number is issued by the office of the DGFT. And secondly, it should be of an approved commodity. What is an approved commodity? Please hold on. Approved commodity. What is an approved commodity? It is something that is freely permissible, or if the person is having an import license of any commodity. In this condition, all the authorized dealers are required to ensure whether the goods imported or intended to be imported are as per the current foreign trade policy, and whether the goods can be freely imported or not, or whether he has to have a specific license that has been issued by the DGFT for the same purpose. This has to be ensured prior to handling of any import bills for collection or opening of the letter of credit for the import of the goods, or before marking and making the import remittances. For this purpose, the authorized dealers should always verify the foreign trade policy and the public notices issued by the DGFT then and there. What is about the payment of the imports? Any person who wants to make an remittance for importers or for imports that he is doing should make an application which is prescribed by the RBI or as prescribed by the RBI to the authorized dealer. The application should contain the details like currency, the total value of the imports, the commodities, the license number of the importer and the exporter as well, along with the undertaking by the importer, and they comply with the exchange control regulations details. Payment for imports should be to the debit of the party's account. The approved method of payment relating to import is as applicable to the receipt in the exports, like the Asian Clearing Union and the other groups that was mentioned while dealing with the guidelines for exporters. So, what is the time limit for the payment in any import transaction? The time limit that has been given as per the guidelines is of different variation. Remittances against imports should be completed not later than 6 months. So, the maximum period that has been given is 6 months from the date of the shipment, except in some cases where amounts are withheld towards the guarantee of performance, etc. So, if a performance guarantee is given, in that case, we can withhold the payment. If not, the payment is to be done in a period of 6 months. And during the period of Corona or the COVID period, the time limit was also increased up to 12 months for any imports that was made prior to the 31st July 2020. It's not that valid now, but this is just for an information. Import of capital goods. The time period that is given is up to 3 years and are treated as trade credits for which procedural guidelines are laid down in the master circular for the ECB, external commercial borrowings, and the trade credits which are to be followed. All the authorized dealers can remit interest on import bills as side basis and also as Usain's bill, generally up to a period of 6 months and up to 3 years in case of the trade credits. If it is a condition of trade credit, then the payment can be done up to a period of 3 years if it is for the capital goods only. In respect of the imports, that is based on delivery against exempt basis, all AD category 1 banks shall verify the evidence of import. Here it is mentioned that the evidence of import, which will be a separate topic coming the next slide. And all these things, all the evidences are to be checked, and only after knowing that the evidence are genuine and reasons such as non-arrival of consignment, delay in delivery or customs clearance of consignment, etc. AD bank, if satisfied with the genuineness of the request, allow reasonable time not exceeding 3 months from the date of remittances. This is in the case of delivery against the acceptance basis. So can a importer go for any advance remittances or advance payment? Yes, he can. And the conditions for that are, then it is up to US dollars 2 lakh. If it is up to US dollars 2 lakh or its equivalent, and after duly satisfying about the transaction, the nature of trade and the standing of the supplier, in this case, the importer can go for an advance remittance. If the amount is about 2 lakh, in that condition, an irrevocable standby letter of credit or a guarantee from a bank situated outside India, which is a reputed international bank, only from a reputed international bank situated outside India, or a guarantee from a bank in India. If such a guarantee is issued against the counter guarantee of an international bank situated outside India, in that case, advance remittance can be done for an amount above US dollars 2 lakh. There is a requirement of guarantee, and the requirement of guarantee may not also be insisted if it is above 2 lakh and up to 5 lakh US dollars, subject to a suitable policy that has been approved by the bank's board of directors, and if a prior approval for the same has been taken from the RBI. So what we are saying is, above 2 lakh dollars, we have to take an irrevocable SBLC. First of all, a standby letter of credit is to be taken, that which is irrevocable, and the bank guarantee is to be taken from a reputed bank that is abroad, and a letter certifying that the same is to be, a guarantee is to be given by a bank situated in India. In the next condition, we are also saying that if the amount is from 2 lakh US dollars to 5 lakh US dollars, it is not required to take a bank guarantee if the bank in India and the board of directors of the bank has taken such a decision, and the same decision was approved by the Reserve Bank of India. In the case of a PSU or a public sector company, let it be a department or an undertaking, which is coming under the government of India or the state government, which is not in a position to obtain a guarantee from an international bank of repute. So all PSUs cannot take a guarantee from an international bank. So in this condition, it is to obtain a specific waiver from the bank guarantee from the Ministry of Finance. So specific waiver is for the bank guarantee from the Ministry of Finance of Government of India before making any remittances which is exceeding US dollars 1 lakh. So within these ceilings, the advance remittances may be permitted after verifying all the documentary evidences indicating the cost of the goods, and the proof of insistence of advance payment by the overseas supplier must be produced as a and when asked by the importer. The importer holds exchange control copy of the valid import licenses from importing goods under the reference, and also ensures that the goods not covered under the negative list. So the importer should hold a valid import license, and he also should ensure that the goods that he is importing is not under the negative list as mentioned by the Reserve Bank of India or the foreign exchange trade. Physical import into India should be made within 6 months. Within 6 months from the date of remittance, and the importer should give an undertaking to produce the documentary evidence of the import within 15 days on the completion of the or the close of the relevant period of the import, and the documentary evidences are to be submitted within 15 days from the close of the relevant. In case of non-import of goods into India, the authorized dealer should ensure that the amount of advance that has been remitted is repatriated to India and is utilized for any other purpose permissible under the extant rules and regulations under the Act. So, what are the guidelines for the evidences of import? So, what are the things that has to be submitted as evidences on the completion of a import? To ascertain the import of goods into India, the importers are required to produce and submit to the authorized dealer who has handled the opening of the letter of credit the details of the bill of entry or the postal appraisal form when the import has come in a postal or a courier route, or the customs assessment certificate, all under the IDPMS system as per the latest guidelines. If it is a customs assessment certificate, it will be through the IDPMS system. We will be going through the heading IDPMS in a later session. So all these are to be updated and to be received by the bank or the AD category 1 bank. Authorized dealers are required to cross-check the parameters and the particulars in the evidence of import with the particulars of the LC that was opened or remittance that was made for the imports. For the purpose of monitoring receipt of summary, record should be marked in the LC remittance register, and all AD should, in all cases, acknowledge receipt of exchange control copy of the bill of entry from the importers by issuing acknowledgement slips to them. The bill of entry should be preserved by the authorized dealer and made available to the internal auditors or the RBI inspectors for any verification. In case of any imports through the postal service or a courier service, the postal or the courier wrapper must be obtained and preserved with the bank, which will help them in the future audits. In case of imports by a company that is listed in a stock exchange whose net worth is not less than 100 crore as on the date of the previous balance sheet, that is on the 31st March of the previous year, all AD banks may accept either the copy of the bill of exchange or a certificate from the CEO of the company or the auditor of the company certifying that the goods for which the remittance was made have actually been imported into India, provided that the foreign exchange remitted is less than US dollars 1 million. All these things, the bill of exchange or a certificate from the CEO or the company's auditor, is to be obtained for the import of the goods in the condition where the remittance that is made is less than US dollar 1 million. This is in the case of a listed company. In case an importer does not furnish any of the documents, if no evidence is furnished within 3 months from the date of remittance involving the foreign exchange, irrespective of the value, AD1 banks or the AD1 category bank should rigorously follow up for the next 3 months by using various modes of communication. It should, however, ensure that at least one of which the communication mode is by a registered letter of the IDPMS. All the outstanding import remittances, irrespective of the amount are that is involved are being reported into the system by the banks itself. So there is no requirement separately to go for a evidence in this condition. If it is through the IDPMS or through a customs mode, customs assessment certificate mode, in that condition, all imports are being monitored by the banks itself. So what is IDPMS? The next topic is IDPMS. IDPMS, Import Data Processing and Monitoring System. So the Reserve Bank had constituted a working group under the chairmanship of Mr. A.K. Pandey, comprising of representatives from customs, the DGFT, the special economic zones, the FEDI, and the AD banks, to suggest putting in place a comprehensive IT-based system to facilitate the efficient processing of all import transactions and effective monitoring thereof. The working group had recommended development of a robust and effective IT-based system, that is the import data processing and monitoring system, on the lines of the EDPMS, the export data processing monitoring system, just a replica of the EDPMS, so that there will be a coordination between all the departments or the all the sections who is looking after the foreign exchange and the export and import things. It was implemented on the 10th of October 2016. Earlier, the coordination between the customs and the banks was not up to the desired level, and hence there was a large gap, information gap, that needed to be plugged in. With the setting up of the IDPMS, it was expected that all the concerned agencies, that is the customs, RBI, and the other banks, will use a common information platform which will streamline the entire process. So the coordination of between the banks and the customs through a common information platform for streamlining the process of knowing the import and export data. This is the main core motto of the IDPMS. It also helps to track the movement of the import transactions through the banking systems. Customs, who was totally looking after the import, has modified the bill of entry format to display the AD code of bank that is concerned as reported by the importers. Primary data on the import transactions from the customs will first flow to the IDPMS server, and thereby, depending on the AD code, it will be shared to the particular branch for taking the transactions that are to be done forward. This is the similar system wherein the shipping bills, in the case of EDPMS, the shipping bills are updated by the AD banks and which will be going to the customs later. So here the opposite thing is happening. The AD banks will enter every subsequent activity after this, that is the document submission, outward remittance data, etc. in the IDPMS, so as to update the database on a real-time basis, and it is done on a day-to-day basis. For that, the AD banks to upload and download data on a daily basis. In the case of the non-EDI or the manual ports, where we don't have the computerized ports, the nodal branch of the AD bank is to upload the bill of entry data based on the original bill of entry with stamp and signature of the customs submitted by the importer. Since all information on submission or non-submission of bill of entries would be available to RBI through the IDPMS server, submission of the BEF statements by the banks has been discontinued. Now, because of this IDPMS, RBI is directly able to monitor all the IDPMS and the EDPMS. RBI is able to monitor all the import and export activities of the country in a single shot. Now, coming to the types of import finance. What are types of import finance? Import finance can be classified into two types mainly. One is the import loans and the other is the import letter of credit, wherein the import letter of credit can again be divided. into buyer's credit and the supplier's credit. Now, first of all, we'll go through the import loans. So, what is the import loan? These are such type of loans that at times are granted against the imported raw material or the goods that are meant for trading. So, the loans that are granted on the raw material or the products that has been imported for trading is not a is known as a import loan. The loans can be against the pledge of the goods or the hypothecation to the financing banks. The items that has been imported can be pledged or be hypothecated. Importers prefer such loans even at higher rates. There is a reason for this. Importers always prefer these kind of loans when there are higher interest rates. The reason being they prefer to keep it for a high longer period as they are seeing that there is a depreciating domestic currency. Since the domestic currency is depreciating, the higher interest rate of the banks on the pledge of the hypothecation loans doesn't matter a lot for the importers as they are saying one thing that the domestic currency is continuously depreciating. The other type of loan is the import letter of credit. The loans on the import letter of credit. This is one of the most commonly used method of financing imports. The importer gets the letter of credit limits sanctioned from his banks and establishes the letter of credit on a usance basis, thereby getting credit from the overseas supplier on the strength of his bank's credibility. So, from where is he taking a loan? He is taking the credit or the loan from the overseas supplier directly on the strength of the credibility of the bank of our country. We have already seen how a LC works in the previous videos, and LC also supports buyer's credit and the supplier's credit, which we have not seen, that we are going to see now in the next slide. So, what is a supplier's credit? Supplier's credit is a credit that is directly extended by the overseas supplier of goods to the importer. We can say that supplier's credit is a financing arrangement where the exporter extends credit to the importer for a specified period. This means that the importer receives goods or services from the exporter and agrees to pay for them at a later date. What is happening? The importer is giving a credit. The exporter is giving a credit himself, or the supplier is giving a credit, wherein the buyer or the importer can take the items. So, what are the benefits of this or the advantages? It improves the cash flows. It allows the importer to preserve cash flow as they have time to sell or use the goods before making the payment. It builds a trust between the exporter and the importer as it demonstrates a level of confidence in the buyer's ability to fulfill their payment obligations. And there is also competitive advantage that it's offering the supplier's credit can make a seller more competitive in the international market. So, what are the other things? It is creating demand in the market and selling it as per the current market practices. The exporter may also avail finance against the bills after making the shipment from his banker, and the bank would receive the funds on a maturity date. The exporter is liable to pay his bank in case the overseas buyer does not make a payment on the due date. In this condition, the maximum amount of supplies credit is up to US dollar 50 million, and an amount more than that cannot be set. The period for the supplier's credit will be discussed in the next slide because both are common. And what is a buyer's credit? Buyer's credit is a credit arranged by the importer from a bank or financial institution outside his country to settle the payment of imports. In short, it is credit arranged by the buyer to settle import payments irrespective of the period of credit. It can also be said the buyer's credit is a type of short-term loan provided by a financial institution to the importer to finance the purchase of goods or services from an overseas supplier. So, how does it work? The financial institution lends money to the importer, which is used to pay the exporter. The importer then repays the financial institution over an agreed upon period, often with the interest. It is not free of cost, it's always with the interest. What are the benefits that a importer have in it? That is the immediate access to goods. The buyer can acquire the goods or services without having to pay the full amount upfront, which can be crucial for large or costly transactions. He also has a flexible repayment term. The importer can negotiate the terms of repayment with the financial institution, allowing him for more flexibility. Does he have any risks? Of course, the interest cost. The buyer may incur interest costs depending on the terms of the credit arrangement. But the buyer's credit worthiness and the ability to repay the loan are the crucial factors in buying the buyer's credit. What is the time period for this? The period is 3 years for capital goods, which is the same for the supplier's credit also. And for non-capital goods, it is up to 1 year or the operating cycle, whichever is less. So, in the case of the suppliers and the buyer's credit, the period is 3 years for the maximum of 3 years for capital goods and 1 year for non-capital goods or its operating cycle, whichever is less, and a maximum amount for which import can be done in a single transaction is US dollars 50 million rupees. Now, coming to the trade credit in Indian rupees, RBI has permitted the resident importer to raise trade credit in rupees within the following framework after entering into a loan agreement with the overseas lender. So, what are it? What are these? Trade credit can be raised for import of all items permissible under the extant foreign trade policy. Trade credit period for the import of non-capital goods can be up to 1 year from the date of shipment or up to the operating cycle, whichever is lower as discussed earlier itself. Trade credit period for the import of capital goods is up to a period of 3 years. This was also mentioned. There is no roll-on or extension can be permitted by the AD category 1 banks upon the permissible period. All other guidelines for the trade credit will be applicable for rupee denominated trade credits as mentioned in the supplier's credit or the buyer's credit. So that's it for the chapter facilities for exporters and importers. We are ending the chapter here. We'll be having a separate video for the case study of it. You have any queries or doubts, it can be updated in the comment section of the video. I hope you are enjoying the video or enjoying the session and it's of some kind of use to you. We would request you to subscribe the channel Brilliant Bankers. This is Nishant signing off. Have a great day. Jai.